Hey guys, Jay here. This is smarthelping.com. I recently worked on a leveraged buyout model with T12 historical data with a client. I've done a couple of these over the years. Did the first one in 2018. It was for real estate, but it is pretty useful. We ended up going a little bit uh, different, more in-depth direction than this and too specific to really build into a template, but this base version I feel like is valuable that I put together here. So I'm going to walk you guys through it, each tab at a time. And a quick high-level overview is you've got a validation tab for dropdowns. You got your T12, possibly T3 data. You've got general assumptions about the project, potentially a loan. You got pro forma monthly all the way down to cash flow, debt service coverage, EBITDA, pro forma annual, a discounted cash flow analysis, and a joint venture waterfall option with um, potentially GP fees for, you know, a general partner, limited partner scenario. Okay, so that's the high level. Let's get down into it, and I actually cleared out most of it so you can see. The best way that I've found to teach people how to use a template is to just show them using it myself, and then you can really get a grasp on how to use it, and then you can kind of run with it. So we're gonna start here. So at the top, I've got 1, 2, 3, 4, 5 different types of revenue I could do. So let's just say and by the way, this version here will be what's sent in the download. Uh, so I've got to remember not to save it as I'm filling out data. Okay, let's say we have sales type 1 and sales type 2. Okay, for contra revenue, maybe you've got refunds, um, returns, cost of goods sold. We can just put cost of goods sold and shipping here. Ads, maybe you got Google ads and Yahoo ads. Expense items, let's say you've got rent, utilities, salary, type 1, couple types of salaries. There's all kinds here. I did about, I think, 20 slots or so. And then this is important here, change sign. So depending on how my T12 comes in that I'm putting in here, because if you've got a LOI ready to go and you are putting in their financials and trying to analyze if you want to buy the company or not, uh, they're going to likely have at least a T12 and you want to get that data and analyze it. So that's where you drop it in here. Then we'll map it to our pro forma line items so that we can produce a projection that is kind of tied to the historicals, and we'll dive into how that exactly works. But for this here, let's say their pro forma has refunds as a negative amount. In that case, on the pro forma here, we want this section, refunds and returns, to be a negative. So if it's already coming through as a negative, I would just say, nope, don't change the sign. But if it's coming through as a positive value on the T12, then I would say yes, change it to a negative. And you can do the same thing with all of these sections. If for some reason they come through as a negative and you want it to be a positive, or if it comes through as a positive and you need it to be negative. It's just a sign change function. It will most likely be relevant for this section here in most cases. We're just going to put yes here, so I'll put some positive. You'll see how it works. Okay, so I got some different revenue types: contra revenue, cost of goods sold and shipping, marketing, ad spend, and some fixed overhead costs. So now let's say I've got some data in here. The description doesn't matter, but this will be, item like revenue, cost of goods sold. It's going to be whatever they have on their T12. They send you the line item description. That's not going to go anywhere, so we're not worried about that. But what we are worried about is column B to M needs to have the 12 months of historical data. So we want to say, let's say this is, I'll just do, ran between, just to get some numbers in here. So we'll say that's revenue. And let's make these numbers smaller. Let's also, whoops, we don't want to go into the year-to-date formula. Okay, and then maybe we have some other ones. Alrighty, and let's do a couple more. Alrighty, in here. Okay, so let's say I've got my T12 data in here. These are different line items from a financial statement, and I want to now classify them in order to flow through to my pro forma model. So line 1, revenue. Let's just mark it as sales type 1. You might have other ones in here, but let's say this second one here is sales type 2. And so what this is doing is giving me my totals for the year and then breaking it down into the monthly average amount, which will serve as our starting basis in combination with the T3, which is just the last 3 months. That could be relevant if you have more recent data, but not full 12 months. And you can put the divisor in here for how many months this data is for. It might be 3 months, 6 months, 5 months, whatever. That'll just give you the correct monthly average on that. We're going to stick to just a T12 for now. Let's say this is going to be refunds. Notice it's coming through as a positive, but we need it to be a negative, so that's why we did our sign change here. We've got, let's say this is cost of goods sold. Say this is also shipping, and then we got some ad spend here, and then we'll say rent. Now, this is not exhaustive. You'll have, possibly hundreds of line items here that you got to classify and fill into your own format or naming. But this gives you the idea of what's going on here. Now we'll come back to that T12. I want to go to the assumptions tab. This can go up to 60 months. So here, let's say we want to do a 60-month forecast. The company I'm buying, I want to do it based on a revenue multiple, and I want to do it based on 1x revenue. So in this, if I do revenue or EBITDA, it's going to look at the pro forma revenue, in this case, 27,646. Or if I do EBITDA, it'll look at this 17,000. And remember, this is monthly, so it's going to multiply it by 12. In this case, we did revenue, so 1x revenue. We look at, multiply here. See, that's 331,752. And that's what we see here for the purchase price. Now, if I did manual entry and I just said, oh, I think I want to buy it for 300,000, then it'll be 300,000 that you buy it for here. So this is pretty flexible. Next up, we want financing. So I'm going to borrow some money to make this happen. Let's say I want to borrow 40% of the purchase price. There's that. Now you could have multiple loans. You could have all kinds of different financing scenarios. This is just a basic P&I loan. Pretty straightforward. If you need custom work, I can do all kinds of different stuff. There's a million different versions of the structure and framework you see here, but this is pretty good for a lot of situations and to help you with underwriting. If you are just starting out buying businesses, this is a pretty good way to kind of get a feel for how to analyze their data, put it into a format that's presentable, and analyze the numbers and tweak different assumptions to see how that makes a deal change. So we're going to try to buy this business for $300,000. We're going to put 40% financing, 60% down. Now this minimum investment required base is, we have a base and an unlevered version. The unlevered is going to do the same scenario, but assuming there's no leverage used. And then the base may or may not use leverage. Like if this was 0%, it'd just be the same as unlevered. But let's say we're financing 60%, or what did I have it at before? 40. Okay, that's fine. So this is saying I need $180,000. And since there's no other operating costs or CapEx being spent at the moment, then the minimum cash required is just simply the purchase price less what's being financed. It does get more complex though. If there's burn and stuff, that will be taken into account, and the investment will be based on the minimum cash required to keep your cash balance above zero, whatever that might be, and it will vary as your assumptions change. Okay, so financing terms, let's say it's just a 20-year loan with a 6.5% rate. Okay, now you can see the loan tabs populated with data. That's going to come over to the pro forma down here in the debt section, and that will affect the debt service coverage ratio once we have some revenue data in here. What else do we need? Include exit, yes. Let's say we want to exit based on the trailing 12-month EBITDA. Let's just say a 4x here. And then let's pretend we are doing a joint venture with an investor group. And so as a GP, I'm going to charge a fee on the acquisition price, let's say 1.5%. Yearly asset management fee based on the amount of funds raised. Let's say 1%, and then maybe there's some initial costs, 2,500 and maybe 5,000. These are just arbitrary numbers. I'm just putting it in. What else do we have? Before we get into these numbers down here, let's look at what we have on our pro forma monthly. So you can see here my monthly average for sales type 1 and sales type 2 is 12.9K and 14.7K a month, total 27K. Notice the refunds coming in as a negative because we have changed the sign. If we were to say no here, you can see this is positive, and now you're actually going the wrong way. So you're saying, well, you had $27,600 in revenue, and your refund was 1.5K, and so net revenue should go down, not up. So obviously that's wrong. We need to have this say yes, change the sign, and that's more like it. Net revenue 26,000 a month. So my starting basis here is going to be a weighted average between the T12 and T3. So let's say we don't even have a T3, so we can keep this at 0, but if there was a number there, we could weight it 1 to 10. 10 being a higher weight, 0 being less. For here, we just got to put in any number, and it'll just come through as that because there's no T3 data. So what this does is you can see right now, I have 0% for all the revenue growth. So this is just the same exact monthly revenue that exists on the T12, the average. So if you look at the 12 months, we're looking at 331,000 in revenue. If you go to here, you can see on the two revenue types, if you add them up, there's 331,752. So that would match our pro forma, which is good to make sure the logic works. Now, for the refunds, I can manually put right here. So this is 5.7%. Let's just put 5.7%. And now that automatically populates. You might have other items in here that you want to add for contra revenue. For cost of goods sold, we can see this is 8% and 8.3% of total revenue. So I would say, well, depending on how you're going to structure the new company, is it going to be the same? Is the cost of goods sold going to be less, going to be more? Let's just put it as the same for now. So 8 and 8.3 for these two. There's up to, like I said, there's up to 5 you can model for cost of goods sold, cost of revenue. We put 2 in here. Now if we make those all the same, you can see now well, it's slightly different. This might be a rounding, the percentage, but it's close to the same. So there's cost of goods sold. Now I have gross profit, my gross profit margin. Google Ads, we're doing 8.1% of total revenue in our T12, so let's just say that stays the same. I'd put 8.1% here. And this is the monthly amount adjustable by quarter. These are quarters. And the first type for revenue, this is going to be your monthly revenue growth by quarter. This is going to be a percentage of total revenue, not a monthly growth rate. This is also a percentage of revenue, not a monthly growth rate. And now that we have that, so there's our Google Ads coming in. Then we have our final one, operating expenses. So here, this is a growth rate. So it's going to start. You can see what it was in the T12, and you can manually put in what you expect the average monthly cost to be for each of these other OPEX items. Let's say it's going to be the same, $22.76. Okay, and then I haven't put any growth in, so it's just going to stay the same, $22.76 per month. Now, as we continue down, the only thing different is so EBITDA should match pretty closely with our pro forma. You can see it's close. There was some rounding on the percentages, but you get the idea of how it flows. CapEx, we're not entering any CapEx there, but let's say you were going to buy some new equipment, let's say for 50,000, then maybe you're also going to do some other renovations or something else for 30,000. Those costs will affect your cash flow and minimum investment needed. As you can see now at the top here, our minimum investment for the base has gone up to 243 because of these expenses here. Okay, so we have our reference points here, the T12 and the T3. We have our data input. Now if I want to say, well, what if when I go to run this new company and buy it, I'm going to have a couple more expenses here for various things. So I'd put those in there, and again, they're just the same because I'm not assuming any growth, but you could here in the expenses, let's say if I wanted to put, 0.5% increase per month, and a couple of those, you can see now those costs would start to go up over time. For revenue, let's say, well, I'm going to take over this company, and really I think I'm going to grow revenue by 1% per month in the first year, first 4 quarters, and then maybe we'll slow down to like 0.25 per month or what have you. This is rounding, there's 0.25, and we could grow consistently at that rate. Now if I go over to the monthly detail, you can see this revenue is now going up. So I'm going to take over the company, I'm going to start growing revenue. I'm going to have your refunds might stay roughly the same. If you think you can improve it, you might put a lower percentage here. And then cost goods sold and sales and marketing, probably as long as the business model is the same, these are probably similar to what the pro forma is, unless you're going to adjust your maybe your vendor terms for inventory costs or more efficient marketing, what have you. They might be less as a percentage of revenue. And then obviously we added a few expenses here. So based on this, we are not profitable at all. The expenses are rising faster than our revenue, I believe. So let's say these don't rise at all and see what that looks like. Okay, we are then profitable by month 30. We're turning a profit, and then we're growing. We actually are not. Our EBIT is less here than even the starting amount, so that probably doesn't make sense. Maybe we grow faster here. Maybe the first couple months we can grow at 5% per month. Maybe for the first 2 years of taking over, then it levels out to maybe 0.25 per month is not bad after that growth. Now let's see what we look at. Okay, yeah, now we're going, okay, 30, 40, 45. So you've significantly raised your monthly income. I don't believe that that shouldn't change anything. Let me relook at this here really quick. No, that's been at 17,000. Okay, I just want to make sure. Okay. Annual, I can see what I'm doing in total revenue and if that makes sense with my strategy, what I'm planning on doing. Net revenue, your cost of goods sold, gross profit, sales and marketing. And down here we've got CapEx, debt service CapEx, other items, so the initial purchase, loan proceeds, the exit value, cash flow, and then the unlevered cash flow here, and service coverage ratio. So pretty solid. Everything's running smoothly. We have our discounted cash flow analysis now that this is completed. I'm not going to do any more assumptions here. So discounted cash flow of the project, cash in and out. So levered or based version, and then unlevered version is same thing, but just no debt. You can see on the assumptions, here's all of the outputs for that. So your trailing 12 months revenue at the exit month 60 is 533,000. At a 4x, it's a 2.1 million exit. Your IRR is 100.1%. Unlevered is 81%. Net project cash flow base 3.6 million. So this is the net essentially profit you're taking away above your investment. If you want to see that number is basically the sum of this here, all cash flows in and out. So you're putting up 267, and then these are your cash returns over time. IRR, equity multiple, and then you can see the same thing if you use no debt. This is what the deal looks like. Pretty straightforward. Now the waterfall can get more complicated. This is using IRR hurdles, which all of these different things are negotiated. There is an option to catch up the GP if they are going to contribute capital. Then they have a catch-up rate where they can get reach their IRR target after the LP has hit their first hurdle and before we go on to the next hurdles. So you've got your tier 1, catch-up, tier 2, tier 3, which is this, and then you got the final thereafter if you get there, and then the summary at the bottom showing here's your investor cash flows, the equity multiple IRR, and the sponsor cash flows, equity multiple and IRR. Now we do have fees here at the beginning, acquisition fees, DD costs, due diligence, other fees, and then your yearly asset management fees. That's all coming away from the available cash that's available to distribute here, but also increasing the initial investment required for the LP and GP here. So, and that's fee income for the GP. So that's all flowing correctly. You can see the totals. Here's our distributions in each tier. So tier 1, for the GP. And we have 0% for the GP here. If I were to put, say, 95.5, okay, now the GP is getting a little bit in tier 1. No catch-up because we put 0%. If I did put a catch-up here, say 6%, okay, now in the catch-up tier, this is the amount of cash needed to get the GP to a 6% IRR. So there's that, and then here's the remaining cash flow to go to these remaining tiers. And we go down through, you can see how the cash is split over time based on these different hurdles. Now this data from the waterfall is also coming back to the assumptions tab in this section. So you can see the GP data here, LP data here. Note this total, if you sum up total invested, total project distributions, plus the fees, this should equal the total net cash project cash flow. So you can see this is 3.605, this is 3.605, so it does match. That should always match. Then you've got your IRRs for the GP and LP, multiple on invested capital, total ROI, and then we've got a sensitivity table here. This is just for the project level, and it's showing you what your different internal rate of returns would be, which is this one for the base version, depending on how much leverage you use, which is this variable here, and then what your exit multiple is, which is this variable here. So without having to change anything, you can see, you know, what is this, 25 different scenarios of IRR based on different exit multiples and different leverage usage. So that's pretty much it. I've done one other leverage buyout template that was similar to this, but what it did not have was the T12. And I've always thought about adding this. I thought it was too clunky, but I think it's possible to make this actually usable for anybody that's looking to acquire businesses. And I think it's actually straightforward enough to be useful to a lot of people. I just have to go in depth in this video and show exactly how it all works, and I think it can be useful to a wide audience. So that's why we're going to make it a template here at Smart Helping. If you want me to make modifications to the template, you can hire me. My rate's $195 an hour. I've built hundreds of financial models over the years. You can check them all out here. Also check out the new Smart Helping Plus program to subscribe to ongoing custom sheets that I've done over the years. Now so that's that. If you want to download the template, links in the description. We can go over to Smart Helping. I'm going to list this in, let's see, for sure in the joint venture. So it'll be in this, included in the bundle. I'll also put it in individually. I think I'll probably price this at 45 bucks, one-time fee. It'll be in probably this section, bonus templates. But it does have joint venture. It's for buying companies. Where else might it might make sense in the industry specific as well. If you're looking at any different business in all kinds of different industries, you might want to use that because everybody's got a T12, so you can get pretty close to a good reference for making projections and get the cash flow pretty close by using the framework we just went through. So I'll probably add it in this section, maybe at the bottom, and they'll just be included in this bundle as well. And it will be included obviously in the all models bundle, which you can get everything I've ever built for $9.99 on the site, all public templates, which are all here. If you go to all financial models, it's all of these, which there's a lot that I've done. This is the other leverage buyout one I did. It's got more in depth on the acquisition for different ways to buy a company, and it's got a little bit more for cost of goods sold and inventory offsets. It's also got receivable and payable logic, so it's a little bit more intense. The one I just did is a little bit, it's more straightforward. It's just for general, it'd be really good for e-commerce businesses, just not too complex or cash basis companies you're acquiring that are cash basis. It's good for that kind of thing. What else? Oh, and so Smart Helping Plus program is moving along. I'll probably add some more templates here at the end of the month. But for April, we've already done 1, 2, 3, 4, 5, 6 custom sheets that I've added. 1, 2, 3, yeah, 6. And as you know, you can subscribe and get ongoing access to all of these. These are all custom versions or models I've built from scratch from Smart Helping that you get here. And these cannot be accessed anywhere else. If you just want a couple of them, I can negotiate like a one-time fee for just a few. But in general, if you just pay $40 a month plus a one-time initial fee of $199, and that's to make sure I can get you set up correctly and for all the initial templates you're going to have access to, you can have ongoing access to everything I ever put in here for $40 a month. So I think this is pretty cool. It's a new program I'm doing. So April we did 1, 2, 3, 4, 5, 6. I might be adding a few more here before the end of the month. I think this is awesome. It gives the whole community access to different things. People like different ways people end up customizing some of the templates here on the site, and that I never end up putting a public version up for. So check that out. What else? Oh, so biogas producer was my last main financial model last week. I'm still in the renewable energy space. I will be probably building some more of those coming up. I did the wind farm model. We got biogas. I also, a while ago, I did hydroponics. We got apple orchard as well, some farming stuff. So we're going to kind of stay in that lane for a bit, see how it goes. I really like the space, and we're making some really cool models. Alrighty, like and subscribe. Check out the site to see what if you like spreadsheets or are in finance or business and want to see the best frameworks for all kinds of different industries, this is where you can get them. Alrighty, take it easy. I'll see you on the next one.